Hi, I'm Rainey with Finance Strategists. In this lesson, we're going to cover
a credit default swap, or CDS, is a type of financial derivative that provides the buyer with protection against default and other risks. A credit default is a default or inability to pay back a loan. The swapping takes place when an investor swaps the risk of not getting paid back with another investor or insurance company. To swap their risk of default, the buyer of a CDS makes periodic payments to the seller until the credit maturity date. In the agreement, the seller commits that, if the loan issued by the buyer of the CDS defaults, the seller will pay the buyer all premiums and interest that would have been paid up to the date of maturity. Just like an insurance policy, a CDS allows purchasers to buy protection against a default on their outstanding loans. Let's look at an example. A company raises money by issuing bonds. A bank purchases the bonds in exchange for interest paid by the company to the bank, but bonds carry a risk of defaulting. To lower their risk, the bank buys a credit default swap from an insurance company. If the bonds default, the insurance company must pay back the principal and all interest payments that would have been paid. Credit default swaps were invented by Blythe Masters of JP Morgan in 1994 and became popular in the early 2000s. By 2007, the outstanding credit default swaps value stood at $62.2 trillion, more than the total amount invested in the stock market, in mortgages, and in U.S. Treasuries combined. There was no legal framework to regulate swaps, and the lack of transparency in the market became a concern among regulators. This all came to a head during the financial crisis of 2008. Many investment banks were involved, but the biggest casualty was Lehman Brothers Investment Bank, which owed $600 billion in debt, out of which $400 billion was covered by credit default swaps. The bank's insurer, American Insurance Group, lacked sufficient funds to clear the debt, and the Federal Reserve of the United States needed to intervene to bail it out. The Dodd-Frank Wall Street Report Act of 2009 was introduced to regulate the credit default swap market. It phased out the riskiest swaps and prohibited banks from using customer deposits to invest in swaps and other derivatives. Let's hear from you. During the 2008 financial crisis, investment banks purchased credit default swaps against risky loans they issued. Insurers of the loans lacked sufficient funds to clear the debt of those they insured, yet the Federal Reserve stepped in to bail them out. Who should have been held responsible? The investment banks, the insurance companies, or the U.S. Federal Reserve? Leave a comment below.
For more information, visit www.financestrategist.com. Finance Strategists, strategies for your future.